Obviously, the big news of the day was the Fed coming out. To a certain extent, it kind of waded into a little bit of political territory here with the expansiveness of, I guess, what can only be called QE4 at this point. Do you think that what the Fed is doing right now is enough to at least not necessarily solve the problem, but at least to sort of tide us over until we get a little bit more help from the fiscal side?
Yeah, look, I think we need to up it from QE4 to QEInfinity. You know, they basically said that they were going to buy it all, and I think the market called the bluff a little bit. I think one of the challenges right now we have is that the Fed's kind of in a box. They have no choice but to keep trying to stimulate with monetary policy, but the market's kind of calling a little bit of BS, saying, "Wait a second, you said that a week ago, 700 billion." Now we're talking multiple trillion, and the markets didn't like it and actually ended up going down. So kind of a tough situation.
And of course, we know everyone's waiting, Mark, for Congress to act and to come up with some kind of package. In the meantime, the Fed is doing what it can to ensure liquidity. How desperate would you say the need is for cash at the corporate level by companies, not just big companies, but small and medium-sized companies, and at funds overall?
Yeah, boy, you really hit on the biggest question out there, which is, can liquidity solve a solvency problem? And, you know, we've seen the liquidity dry up everywhere. You know, I was talking to a friend a week ago, said that she was looking at the Treasury market and there were no bids, literally no bids. And we started to see that leak into corporate bond markets and commercial paper markets. And I think that was a lot of the announcement this morning. You're also seeing a problem in that hedge funds with lots of leverage are needing liquidity. And your point is really spot on, which is, look, what about businesses that are now shut down, literally shut down because of the national lockdown, that are going to run out of cash? You know, the average restaurant, I think, has 17 days of cash. They've already been closed for a good part of that. So I think the cash crunch is going to lead into some other real problems over the next few weeks.
Listen, Mark, we've been listening and waiting here for Congress to take some action. Meanwhile, we have the Fed pulling out unprecedented actions. What are the risks to the Federal Reserve pulling out so many stops at this point?
Again, really important point. You know, if we think about history, history tells us that there's a cyclical nature to markets and the business cycle itself, and that in that ebb and flow of business activity, the central bank usually reloaded the gun, to use that analogy, and they raised rates to slow the economy down. This time, back in 2015-16, they never did that. They never, you know, increased their arsenal. And I think we're finding they're in a very tricky position today in that they don't have the normal ability to cut rates. They've tried that. They cut rates all the way to zero, and the market said, meh. So they've said, oh, well, what about doing more QE? Well, it's like any drug. The first time you administer that drug, it works really, really well. The second time, a little less well. The fourth or fifth or sixth time, you need a whole lot of the drug to get the same effect. And I think that's what we're seeing with this promise of QEInfinity, and the market saying, well, I don't know if it's enough. So it's a really tough position for the Fed.